Okay, welcome to Wall Street Value. This is Tom Vylord. I want to share with you one way to value the entire market. The main goal of Wall Street Value is to help you identify and value great companies. So after you take the course, you've learned how to find investment ideas, then you've learned how to analyze these companies, determine what is a good company, what is not a good company, and once you find these great companies, you're going to learn how to value them. And it's only natural that once you learn all of this information, you're going to want to go out there and start valuing everything and start putting your money to work right away. Because the market will tell you when there's going to be some opportunities available and when there's not going to be opportunities available. So as we're recording this, we're in 2017. The market's been on an extremely raging bull run since 2009. And the market's at 21,000 right now, which is an all-time high. So when the market is overvalued, chances are those great solid companies are probably going to be overvalued as well. So it can be frustrating having learned all this new information and not being able to do anything with it. So how do we determine if the entire market's overvalued? So there's two pieces of information that we look at. We've taught you before how to use the price-earnings ratio to determine where a company is right now based on its historical valuation. We can do the same thing with the S&P 500 index. So the S&P 500 index has a PE ratio, and it's historically traded around about 16 and a half going back decades. As of today, it's at 28.9. So that is significantly overvalued compared to its own historical valuation. The second indicator that we look at is the Buffett indicator, which is actually called the market cap to GDP ratio. Warren Buffett did an interview back in 2001 in Fortune magazine, and he said that particular ratio is the single best measure out there to determine where valuations are at any time. And if you take a look at the history of the Buffett indicator, whenever it has a reading between 70 and 95, that's considered a fairly valued market. 90 to 115 is when things start to get overvalued. And anything over 115 means the market is significantly overvalued. And it's at 123 as of today. So the S&P is incredibly overvalued compared to normal valuations, and the Buffett indicator is extremely overvalued compared to historical valuations. And there's only been 3 other times in its history where the market has been this expensive. So again, getting back to valuations, it's going to be much more difficult to find really good companies at really good prices in this type of market environment. So what do? We can sell puts, which we already taught you how to do. You can be prepared and have more money sitting in cash than you normally would because there's nowhere else to invest your money at good prices. So if we do see some type of sell-off, whether it's a major market correction or a minor correction, the market's going to come down. And when the market comes down, you're going to have money in cash where you'll be able to take advantage of those new opportunities. And that's what we're doing with our holdings. So the holdings that we own that have reached the target price, we're selling them. They're sitting in cash right now. We're trying to find places to reinvest it, but it's becoming harder to find right now. The holdings that we have that have not reached its target price, we're leaving them put. So this is just one more way to look at where the entire market valuations are. So when we've determined that market valuations are pretty high, we just need to exercise some patience. A lot of times we'll find some opportunities. For example, Manpower. Manpower, a news event caused that company to get beat up in June of 2016, and a couple months later it rebounded. Sometimes we'll find a value stock, it got beat up for whatever reason, and it'll take a year or longer before that comes up to its true value. Right now, there's no opportunities available, at least none that I could find. And so we need to be patient. We need to be smart with our money and do not go rush in to buy something just to put your money to work. Because as value investors, we're investing in great solid companies that are at a discount. So we're never going to buy an overvalued stock. We're never going to buy a fairly valued stock. We're going to wait for that company to become priced at a discount. Then we wait for that to come back up to its true value, and that is how we make money as a value investor. Thank you.